As a swing trader, your aim is to make the most money possible in the least amount of time, and you can't do that if you're always buying crappy looking charts. When I first began trading stocks, I pretty much traded anything. I didn't care if the chart moved as slow as a sloth or as extreme as a roller coaster. But eventually I learned the hard way that you're only as good as the stocks you choose to trade. So to help you minimize losses and reduce stress, here are 7 types of stock charts to avoid and the types of charts you should be focusing on instead. So the first type of chart you should avoid trading are choppy charts. You know, the ones that are up big one day and then down big the next day, and they continue like this for absolutely ages. And just when you think you figured out its movement and you buy the stock, it suddenly reverses, takes out your stop loss, so you short it instead, and then it makes an explosive move to the upside and takes out your stop loss again. This is really frustrating, and it's happened to me more times than I can care to remember. There's just no predictability and the moves are so volatile, it's hard to manage your risk. So there's really no point in trading them. And the next type of chart you should avoid is mostly red charts. This is particularly true if you're a long only trader like myself. If you see a chart that has mostly red candles with a lack of green candles, then this typically means that the natural behavior of shareholders is to sell. This makes it hard for the stock to gain any upward momentum, and even when it does, it cannot sustain its gains. Now, these types of stocks can change their nature down the line, but it usually takes a strong and long-lasting catalyst to draw institutional support and long-term investors. Until that happens, I would withhold from trading these. Moving on to the next type of chart to avoid is downtrending charts. Look, no matter how tempting it might be to buy a stock that's been in the downtrend for a while, it usually ends in tears. Obviously, sellers are in full control and momentum is to the downside, so why would you even buy it? Well, I know why. You want to try and time the bottom, don't you? Yeah, I've been there before, so I know just how hard it is. Unfortunately, the stock market isn't like a shopping mall where if things go on a sale, you should try to buy it. But rather, if a company is constantly getting discounted, it doesn't mean you're getting better value for your money. It just means that the company, it has fallen out of favor with investors and there may be troubles looming ahead. It may even be on the brink of bankruptcy. It doesn't matter how much you believe in the company. Sorry to say, but your opinion, it doesn't really count. What really matters is whether the large institutions are supporting and buying the stock. And if they are, that will usually be reflected in the price action anyway. So instead of the stock being in a downtrend, it'll either be consolidating or in an uptrend. Speaking of downtrending charts, you'll also want to avoid overextended charts. There are 2 types of overextended charts. Let's start with the one that's overextended to the downside. Now, these types of stocks may be in a downtrend, uptrend, or going sideways, and then out of nowhere, bad news hits the company and triggers a massive sell-off. You'll see long red candle after long red candle, sometimes combined with long wicks on either end, and you're thinking it can't possibly go down any further, can it? So you try to catch a bounce, i.e. you catch a falling knife, and you end up hurting yourself badly. Now, that wasn't a very bright idea. And even though these types of plays can present a good risk to reward, they're notoriously difficult to catch, and your timing, it needs to be pinpoint precise. There's little to no room for error. On the flip side, there are stocks that go to the moon, but unfortunately, you've been left behind. While everyone else is strapped in and enjoying the ride, you're watching from the sidelines. This makes you go into FOMO mode, so you parachute onto the rocket at any random location or you short the stock, hoping for it to crash back down to earth. Both choices are often disastrous. If you randomly buy a stock that's going parabolic, there's a high chance of a reversal. The higher the stock goes, the riskier it is to buy. Now, on the other hand, shorting a parabolic move is even riskier because there's also a good chance of the stock shooting much higher. God forbid the stock gaps up massively overnight and you're still holding onto your short position. you're going to need to change your underwear. The moral of the story is don't trade overextended charts, since you're always left in a dangerous situation. The next type of stock chart to avoid trading is Gappy Charts. Once in a while you come across a chart that has so many gaps between each day, and you're wondering what could possibly be causing all of these gaps. A gap up or gap down happens when there's out of hours activity that moves the price in either direction. So when the market opens the following day, its opening price is different from the previous day's closing price. Sometimes this is caused by a catalyst like earnings or news about the company. But when you see these gaps appear so often for no reason, that's a cause for concern. It might be a foreign company that is listed on the US stock exchange but has lots of investors in another country. Their working hours are different, so they'll usually end up trading the stock when the US markets are closed. You'll see this a lot with Chinese stocks, where many of them are listed on a major US stock exchange, but they still attract a large amount of foreign investors. Or sometimes it may just be the next type of chart, which is low volume charts. A stock that has barely any volume not only results in loads of gaps, but also they often have increased volatility and wide spreads, which is the difference between the buying and the selling price, i.e. the bid and offer. This makes it harder to control your risk, since you'll almost always end up paying a higher price or selling at a lower price. This is known as slippage. The lack of trading activity on these illiquid charts are evident on the daily time frame and even the lower time frames. You'll see gaps between the closing price of a candle and the opening price of the next candle. These types of stocks can be of any size company from small to large, but they're usually of the smaller variety. So regardless of the size of the company, if there's a lack of volume, it's best to avoid trading them. And lastly, we have slow moving charts. Trading takes many years to become profitable and even more years to become rich. But it's going to take a lifetime if you're trading stocks that take forever to gain momentum. If you're a long-term investor who's willing to wait years for something to happen, then by all means, keep buying these boring but safe stocks. However, if you're a trader, you want to be where the action is. That usually means you have to avoid the slow growth sectors, particularly if they're massive companies. Such sectors include banking and finance, consumer defensive, utilities, and real estate investment trusts. Instead, you want to trade the stronger stocks in the fast growth sectors such as technology, healthcare, and consumer cyclical. It also helps if the company is not huge, so there's more room for growth. So now that you know which types of stock charts to avoid, you're probably thinking, well, you pretty much ruled out 95% of stocks, so what exactly can I trade? Having so few stocks remaining to trade is a good thing. Just like how a jeweler will pick out the highest quality diamonds to sell, it's essential for you as a stock picker to filter out all of the BS stocks and select the best ones to trade. Focus on charts that have the following characteristics: trending above the 200 SMA, preferably the 50 SMA, more up days than down days, steady and predictable movements, like a staircase formation with higher lows and higher highs and consolidation periods. A consistent and good amount of daily volume, preferably over 500k shares traded per day. A stock that typically follows through on your specific setup. Now these types of charts will look like these. Whether you're trading breakouts, pullbacks, or EPs, these types of stocks present you with opportunities to make great returns in the shortest space of time possible. If you pick enough of them throughout the year and do some decent size on them, you can double or even triple your account. In trading, half the battle is won just by avoiding the 7 types of stock charts I mentioned. You can use a stock screener like FinViz to filter and narrow down stocks, but you'll have to put in the manual labor to look over different charts and determine by yourself if they're worth trading. If you found this video useful, just hit the like button and don't forget to subscribe for more swing trading tips. See you in the next video.